Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. It's been a while since I did a podcast episode related to real estate investing. With the Feds finally decreasing interest rates, people are hoping that the cost of mortgages will also decrease. Mortgage rates do seem to have declined to the low 6% range from where they were a year ago at the mid 7% range for a 30-year fixed loan. Back in February, podcast episode 89 talked about the rise of capital calls in real estate syndication investments. At that time, I had one of my syndications with a capital call. At this point, I have now had two capital calls. Both are actually with the same sponsor, a group called Tides. One of those capital calls was with an individual real estate syndication deal where I knew the property I was investing in, and I knew that I was investing with Tides. The other investment was within a real estate fund where I didn't actually know when I invested in the fund what would necessarily be in the fund. This week, I thought I would compare investing in individual syndications versus real estate funds. Before I start with those comparisons, let me discuss more what a real estate syndication is and what a real estate fund is. Real estate syndications are investments where a group of investors come together to purchase a property or even possibly multiple properties. There's typically a general partner or partners, often called the sponsor or syndicator, who does the active part of the investing. They're the ones who are going to find a property, secure the loan with the bank, create the business plan, and then execute the plan. Properties could be a multi-family apartment building, a self-storage facility, a commercial building, a warehouse, a hotel, a strip mall, really any kind of real estate. There are also real estate syndications that will be in the development stage, where they buy land, get all the permits, and build the property from ground up. Active real estate syndicators will generally be doing multiple projects, though they may be working on one project at a time. They look for people who want to passively invest in their projects and to be limited partners in order to have money for the down payment, initial rehab cost, and other operating expenses. This is where an accredited investor can passively invest in an individual real estate syndication. A real estate fund invests in multiple properties in order to provide more diversification. The fund may invest in individual syndications run by different sponsors, or the fund may be with one sponsor, but spread out among multiple investments with that single sponsor. Even if the fund invests in projects of different sponsors, there will still be someone who's running the fund itself, who can be thought of as the sponsor of the fund. The fund may have a specific focus, like investing only in multifamily apartment complexes within a certain state, or it may be more broadly focused, both in the type of real estate it will invest in, as well as what geographic location it invests in. Whenever you make an investment, you should know what you're investing in. In the case of real estate syndications, it's also important to know who you are investing with. Getting to know the sponsor of either the individual investment or the fund is part of your due diligence as an investor. You want to know their experience and their track record. Do they tend to be more conservative or more aggressive with their projections? What is their investment philosophy? An excellent sponsor can turn an average deal into a great investment, whereas a not-so-great sponsor can take an amazing deal and end up losing money for their investors. With an individual real estate syndication, you know exactly what property you're investing in and who is the sponsor or the general partner who's managing the investment. You can fully investigate the investment itself and get information specific to the property investment and the business model. You can attend webinars where the sponsors introduce themselves and lay out their plan. You can ask questions specific to the investment and actually get answers from the sponsors that you're investing with. You'll know where the property is located, so you can do some of your own due diligence. You can research rents or income for similar properties in that area. You can fact-check information that is provided by the sponsors in the materials they give you. In contrast, when you invest in a real estate fund, you may not know what investments will be in the fund. When a new fund opens for investment, It may be open for a few days or a few years. Generally, a fund will have a specific amount of money they want to raise, and once they reach that number, they'll close the fund. When a fund first opens, they haven't yet purchased any properties for that fund. As time goes on, there will be some properties purchased. So if you enter the fund in the mid or late stage, you may be able to see the investments that were already purchased by the fund and learn information about purchases being considered or that are in the process of due diligence. Even at the late stage, it's possible to not know every investment that will be in the fund. This sounds like it's more advantageous to invest in a fund in its later stages when you can see the investments in the fund and get some information on how those investments are progressing. Sponsors recognize this, so they may provide incentives to invest when the fund first opens. Of course, that depends on the sponsor. There's more likely to be incentives if the sponsor typically opens a fund for a few years to raise a lot of money in order to have a lot of properties in the fund, compared to a smaller fund that may be open for a few days or a few weeks before they really fill up with commitments of investors and reach their funding goal. Since with the individual syndication, you know where the property is located, you'll also know where you have to file state taxes at the end of the year. With a real estate fund, you don't necessarily know all the states that you may end up owning an investment. You may find yourself with investments in 6 different states across the country, or even more than that, with a single fund investment. If you pay your tax accountant $50 per state to file, this can add up quite quickly. Your investment return may be significantly decreased by what you're paying your accountant over all the years to do all the state tax filings. There are some funds that invest in limited locations, so you know exactly what states you'll end up having to file taxes in. Some people say that you don't need to file state taxes every year, since in many years, you'll show a paper loss and you won't owe any taxes to that state. Please consult with your accountant on this matter. My accountant actually has me file state taxes in all the states that I'm invested in, other than those states that don't have state income taxes, like Texas. While we're on the subject of taxes, whether you're investing in a single syndication or a real estate fund, plan on filing for a tax extension before April 15th. You'll receive a K-1 for your investment, and you're very unlikely to receive that K-1 before the April 15th tax deadline. If you currently have simple taxes with only W-2 income and have been doing your own taxes, you may want to switch to having a tax accountant who's knowledgeable about real estate and business taxes to do your taxes. This may be another expense that decreases your overall return if you're not already using an accountant. Your accountant may also charge you per K-1, so even if you're using an accountant, the amount you pay for your taxes to be completed may increase when you start investing in real estate syndications. Another difference between investing in individual real estate syndications and real estate funds are the minimum investments. If you're investing directly as a limited partner in an individual real estate syndication, typical minimums range from $25,000 to $50,000, but could be as much as $100,000. For a real estate fund, the minimum starting is usually $100,000 and can be $250,000 or more. Although the minimum investment for a real estate fund is higher than with individual syndications, you typically get more diversification for the amount invested. If you have $100,000 to invest and do so in individual projects, each with a minimum of $25,000, then that would limit you to 4 different projects or syndication deals. Many real estate funds with a minimum investment of $100,000 will invest in more than 4 different properties, and it could even be more than 10 different projects. MLG Capital's MLG Private Fund 6 has the goal to invest in over 25 projects, which provides great diversification. But they also invest across many different states, so that is something to keep in mind. Which leads to the ultimate difference between investing in an individual real estate syndication compared to a real estate fund. When you invest in one syndication, you're adding diversification from a purely stock and bond investment portfolio by adding real estate, but you aren't getting diversification in your real estate investment. It's possible that an syndication may include multiple properties, but even if that's the case, usually it's the same type of property in the same market. it is possible to lose 100% of your investment in an individual real estate syndication. With the fund, you're investing in multiple real estate properties. While it's still possible that all the properties perform poorly, especially if it's the sponsor's action leading to poor performance, it is overall less likely that every different property will not do well. You can also choose to invest in a fund that's more widely diversified, also making it less likely that all investments will perform poorly. For the fund I'm invested in, which had a capital call, the one investment with Tides is not going well, but all the other investments in that fund are doing very well. So even the Tides investment is a total loss, the overall investment in the fund should still be profitable. All other things being equal, more diversification is generally better when it comes to investing. This is why it's better to invest in a broad, low-cost index fund than picking individual stocks. If you've never invested in a real estate syndication, but want to diversify your portfolio in real estate in a passive way, it can feel scary to invest $100,000 to a real estate fund all at once. It's possible that $25,000 to invest in a single syndication may feel more palpable. There are also ways through crowdsourcing sites to invest in real estate with smaller amounts. While I have personally not explored this route towards real estate investing, Equity Multiple lets you invest with as low as $5,000. Arrived, another platform, lets people purchase fractional ownership in rental properties with an account minimum of $100. There are other platforms too, and you'll have to look specifically at what each platform is offering and whether that fits your financial strategy. But know that there are lots of options, which is always great to have. Before making any investment of money, be sure to invest in your financial education. If you're interested in learning more about investing in real estate syndications, I highly recommend the book, The Hands-Off Investor by Brian Burke. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. I want this podcast to be useful to you, so please let me know what gaps you feel you have in your knowledge base to achieve your financial goals by emailing me at growyourwealthymindset@gmail.com. If you would like personal help to reach your financial goals, come work with me. Schedule a Zoom meeting at www.growyourwealthymindset.com so that we can chat about your financial goals and what's stopping you from reaching them. Imagine feeling confident about money and having an investing plan in place, knowing that you're making progress towards your financial goals. All of that is available to you. Have a great week, and I'll be back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician, so if you need any medical advice, please contact your own physician. Thank you.